Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
2 weeks away from a Federal Reserve rate decision. 2 weeks tomorrow. Lindsey Piegza of Stifel writing the Fed should be on the verge of a pause in policy adjustment. While Fed officials are anxious to provide less firm policy after 14 months at peak levels, the risk of unwinding policy too soon or too fast is a reignition of inflationary pressures and a reversal of the progress already made. Lindsey joins us now for more. Lindsey, good morning.
Good morning. Thank you for having me.
What did you make of Governor Waller yesterday?
Well, I think this is really the general theme of what we're hearing from Fed officials as of late. They're setting the bar noticeably higher for a potential pause, saying it's no longer about a strong or solid economy, but it's about the data outperforming expectations. Or as we heard from Goolsbee last week, it's about a potential economy overheating. So I do think that the Fed is gearing up, to push through a third round rate cut in December. But as we turn the calendar page next year, if the data remains as strong as it is, if the economy continues to prove remarkably solid, as Chairman Powell described it, I do think they're going to be backed into a corner and forced to take a potential policy pause.
I've got to ask you what kind of data would change the conversation. I think Governor Waller compared fighting inflation to a UFC fight in the Octagon yesterday. I'm not sure how helpful that is for people or not. What kind of number would it take?
Well, remember, looking out to Friday's non-farm payroll report, the strength is going to be outsized, or at least we expect that. But that's going to be offsetting the weakness that we saw the month prior. So even a number 220,000, I don't think that's going to be enough to deter the Fed from pushing through that December rate cut.
MMA, I think it was. It was in
martial arts.
Yes, I think it was
in UFC.
In UFC. Thank you. That's good. I'm still trying to wrap my head around the hard words that he had about getting inflation in a headlock and driving it to the ground in the last round to the actual, okay, we're still going to cut rates. I mean, it sort of raises this question. How much do you think that they are still underestimating the inflationary pressure in an economy where it's not about the labor market as much anymore as the inflation read that we get the following week?
Well, that's exactly right. The concern of this emerging weakness in the labor market prompted that outsized 50 basis point cut in September. We didn't see that weakness come to fruition, and so then they followed through with another 25 simply because I think they were worried about having egg on their face or admitting a policy error, being too aggressive the month prior. But to your point, they don't have inflation in a chokehold. They need to keep their eye on the ball because the past several months, inflation has really moved to the sideways with no further improvement to speak of. So at this point, yes, we have made discernible progress down from peak levels, but we still have that last mile to go, and now is not the time for the Fed to give up on that goal.
John was asking earlier about this discussion around neutral rate, saying that there is quite a ways to go before you actually get to truly a neutral rate. At the same time, that some of us are struggling to see the restrictiveness in terms of rates, other than a couple of pockets for a couple of segments of the population. Do you see us as anywhere close to restrictive?
So that's a good distinction that we need to be made because right now policy still is very firm and changing conditions, further improvement in disinflation does warrant less firm policy as we move towards neutral and the data normalize. But we need to do so at a very slow and tempered pace. So I don't think the question is, do we justify further rate cuts? I do see further rate cuts on the horizon, but the pathway, the pace to that lower level of Fed funds needs to be very controlled as to not overshoot or undermine the progress that we've already seen made on the inflation front.
So how many cuts can you actually see next year when they have to recalibrate for potentially tariffs, tax cuts, and a whole host of new policies coming out of Washington?
Well, assuming they do push through the December cut, that's the third round cut, I see 3 more cuts in 25 on a quarterly basis. So 1 25 basis point cut per quarter, getting us to 3 3/4 by the third quarter. And I think that's a reasonable neutral level. Now, of course, some policy issues may limit the downside potential if we do see tariffs or sizable tax cuts lead to further inflationary pressures, but that's a big question mark. The inflationary pressures that we're assuming under those scenarios could very easily be offset if we saw sizable reductions in government spending or other areas. And so it still is questionable, the net outcome from the incoming administration. But right now, ceteris paribus, I do expect 3 additional rate cuts next year, taking us to a neutral rate of about 3.75.
If we get the December cut, how hawkish do you think the tone might be from Powell? Because he's looking into a lot of unknowns for next year.
How much more hawkish, you mean? At this point, he's talking about a remarkably solid economy, remarkably strong labor market. So he's really laid the groundwork for a pretty solid assessment of current conditions. Again, keeping that door wide open for a near-term policy pause as soon as they deem it appropriate. And again, if December data comes in within expectations, I think the Fed continues to follow through with a third round cut, but they've already set the table for a potential pause given the strength that we're seeing in the consumer, in business investment, even in housing, and that sticky nature of inflation.
So John has been trying to draw a parallel between Xi Jinping and Jerome Powell today.
A single parallel.
A single parallel.
One similarity.
Okay, carry on.
Would you like me to explain that similarity?
No, it's okay. I got it. Go ahead.
If you just join it. I'm not insane. You might think I am. There is one similarity. They've got to wait to calibrate policy to work out what the policy changes will be in the United States. That's the single similarity.
Do they? And that's my question. Lindsey, do they have to, does Jay Powell have to wait to understand what the policies are? Similar to Xi Jinping, who has to wait to understand what policies are.
Well, I think that need to wait. I think that's in part why they want to push through this policy, this third round reduction in December, before we get some of the details of these policies that will be associated with the incoming administration. But again, when that calendar page turns to 2025, if we're still talking about the strength of the data, that's where the patience needs to come in. That's where we need to see the Fed take a pause, move to the sidelines, and allow the data to continue to evolve to dictate the best course of policy.
It's also not obvious to me how inflationary tariffs will actually be, given the first round experience, how they'll be calibrated this time. Wells Fargo put out their outlook for 2025 this morning and said the most concerning effect of tariffs is on growth and not necessarily inflation. Working that out is actually not that obvious for next year and beyond.
There are a number of arguments that are legitimate, saying that actually tariffs are disinflationary, and that actually the more inflationary impulse is going to come from the immigration if there are significant deportations. So it's a policy mix, it's a sequencing, it's just in terms of how they actually are carried out. All have a very big difference depending on how it goes.
Lindsey, it's good to see you. Always great to catch up. Good to have you in New York. Thank you. Lindsey Piegza there of Stifel. Let's turn to retail. Let's squeeze this in. Adobe expecting a Cyber Monday splurge, forecasting consumers spent $13.5 billion. Oliver Chen of TD Cowen saying, while we see some selective opportunity for consumer holiday spending this year, by and large, the consumer remains choiceful and is carefully balancing needs versus wants. Oliver Chen joins us now for more. Oliver, welcome to the program, sir. I want to start with luxury, as we often do with you. I want to ask you a simple question. If luxury goes on sale, is it even luxury?
Well, that is the great question in terms of the balance of luxury and exclusivity. The best brands, John, don't go on sale, and those include Louis Vuitton and Dior. So that brand does not go on sale. Other brands that have been struggling, including Gucci, we are seeing markdowns, and the department store channel has been under pressure. So we're not recommending those stocks, which include Macy's and Nordstrom and others, and that's been something to watch. The consumer remains focused on value. As you know, Walmart has been a top idea, and Walmart is really executing well with lots of great deals across food and consumables. Luxury is something to watch still. And as you mentioned earlier, the situation in China is more anemic growth as well, and that's something to consider. And consumer confidence has been volatile. On the one hand, we have very low unemployment as well as $1 trillion of savings on the sidelines, but consumers are being choiceful and watching and not buying everything in sight, really looking for the best bargains. And the best luxury brands do remain full price.
I appreciate your ability to jump between Gucci and Walmart. If we can just stay on Gucci, Oliver, and then we can move on. I want to sit on Gucci. I think this is important. I'm going to get into some hot water here, but here goes. The kind of people that buy Gucci are the kind of people that want you to know they've bought Gucci, And I think that's really important. They want the belt with the big Gucci emblem on it. And I just wonder how incompatible stealth wealth and quiet luxury is with that particular brand.
Well, we got to have both. What's really happening at Gucci now is a return to timelessness and also elevation with a new designer. We really like what he's doing. However, these turnarounds take time, and we think it'll take a year in terms of rebooting the brand and also harmonizing service levels across the globe. They're also adding a lot of creative, John, to this. There'll be bigger and better shows and storytelling. That's what really needs to happen at Gucci. At the moment, quiet luxury, thinking about timelessness, elevated materials, that's really working. In a way, that luxury consumer is looking for value and items that they can use throughout, but it's a little bit boring. And conversely, a quiet luxury can be an excuse for no innovation. What if that's true? So we really need to have both. We need to have the exuberance, and we need to have the fashion, and we need to have the quiet luxury. So a little bit of logo in the future will be quite positive for Gucci.
Love it, a little bit of logo. So from logo back to Walmart, I'll talk about that. I am curious about how you have seen this outperformance on an ongoing basis this holiday shopping season from the online systems. And basically, this has been the trend for a long time. How does this challenge companies at a time when it is less profitable for them to sell online, where they have big physical stores that aren't necessarily getting the same kind of foot traffic as they have in prior years?
Retailers have to do everything everywhere all at once. So the name of the game is channels such as curbside pickup, where you're doing more of the work in terms of the last mile. Also, as you think about technology at large, the future of retail includes digital advertising as well as artificial intelligence, and then growing these marketplace models to have third-party sellers very similarly to Amazon. So you're retaining a lot of the productivity of the box, and you're becoming less unprofitable in online, and that's happening at Walmart over time. It's a bigger challenge at Target, which is losing money online. The prospect for Walmart to become e-commerce profitable, that will happen within 1 to 2 years, in part because they have so much scale and they're increasing delivery density. Also, consumers of all kinds are choosing to pay for express shipping. That's happening as well. And Walmart's getting a higher household income consumer. So this really is difficult, but it all needs to work together. And digital advertising is a very high margin business, 70% plus margins.
How big of an advantage do the likes of Walmart and Amazon and other large retailers that have these sort of multi-channel businesses have when it comes to the likes of tariffs, which pretty much universally we're expecting to hear about early next year, to have them implemented?
Across the sector, in terms of the analysis, the earnings per share hits will be mid to high single digits. In terms of themes and stocks to play, you own those with the most scale. Walmart also has a history of working quite aggressively with suppliers on managing prices. So we like the prospects of Walmart. The big question and the big opportunity and the big unintended consequence of tariffs will be passing this cost on to consumers, which may yield inflation. So we'll see. We think as much as 50 to 90% will need to be passed on to consumers, and it's something to watch. But you're going to want to own those with scale, and Walmart and Costco definitely fit the bill here.
Oliver, I'd love to talk about department stores. I know you're not too excited about Macy's. Are there any department stores you like? And do you think they're going to have to lean into more sales leading up to Christmas? I mean, I opened my email this morning and I got Bergdorf Goodman saying extended one more day for the Cyber Sale. Does Cyber Monday even exist anymore, or is it just Cyber Week?
Well, it's definitely the Cyber Month and T-40 in terms of the events have started earlier and they're more spread out, and people aren't trampling each other anymore. It's not as exciting as it used to be. So that's happening, and also lots of markdowns on the markdowns, definitely. As we think about department stores, we like Nordstrom Rack, but what does that mean? It means department stores are changing to be more off-price and offer value there, and Nordstrom Rack did a pretty good job. We're hopeful, but the big problem is getting younger customers in stores and store traffic. The other nature of competition is changing rapidly in apparel with Shein and Temu and ultra-fast fashion and the TikTokification of retail. thinking about social selling. That's something department stores are facing. The future is more exclusive products. So Macy's is upgrading their private brands. That should be a positive for getting younger consumers as well as older consumers back in store.
Ollie, appreciate your time, sir. Oliver Chen there of TD Cowen. Of Standard Chartered writing the following. The question is, what is core Trump and what is tactical Trump? Core Trump is not wanting to see US prestige and US interests put at risk. Tactical Trump is a threat of tariffs to see what concessions he can obtain. Steve joins us now for more. Steve, let's talk about those threats. Are they credible threats? And do you and do the people that you speak to every single day believe that he'd follow through on them?
I believe, and I think they believe, that he'll follow through on them if he doesn't get satisfaction on, in terms of changing policies and getting some visible concessions from other countries. The question, does he actually want to slap on the tariffs on Canada, Mexico, other allies, or does he just want them to adjust their policies and kind of be more friendly towards buying U.S. products, and that's probably the case. I think, more than protectionism, he's probably doing what you could call a protection racket, which is going to them in advance of his being in power and saying, look, if you want to avoid trouble, this is what you got to do, and if you cooperate, then things will be fine. And I think that that's his preferred direction. We'll have to see how far they are willing to go, and exactly what he does once he gets into office, and whether he focuses on countries that are large trading partners, or whether he focuses on China more directly because of the national security issues he sees.
Steve, how strong is too strong for the dollar, given some of the policies that we've heard from President-elect Donald Trump? And I say this as we already see some exports from the U.S. really fall off significantly, and at a time where this has been a president who has waffled a bit when it comes to whether he wants a strong or a weak dollar.
Yeah, and I think there's a reason to waffle, because on the one hand, you dollar dominance is a tremendous privilege and a tremendous advantage, and enhances the U.S.'s role, both financially and politically, in the world. Everyone talks about sort of the reaction to the tariff threat, but if I was a U.S. exporter or even a U.S. farmer, and seeing the dollar, run up to 105, it was 109 against the euro before Trump election odds started going up. If I was a manufacturer who was depending on exports, I'd say, where's my tariff, or where's my subsidy, where's my protection? Because that segment is going to be damaged. So I think that everybody, I think there's something to be said for a strong dollar, and often it's a sign, a positive sign, that capital is flowing into your country for good reasons. But I think that remains to be seen. And just to finish this thought, I think the judgment on the Trump economic policy is not going to be done on the basis of tariffs. It's going to be done on the basis of how successful they are in terms of cutting government spending and doing the sort of structural and productivity enhancing reforms that the Scott Bessent and the Doji team are promising. Because if they're successful in that, the dollar will be strong, but it won't matter. If they're unsuccessful in that, the dollar will be weak, and it won't matter.
Can we talk about the other side of the euro-dollar trade? When it comes to the euro, now we're facing a French government on the brink of collapse. Germany will have fresh elections at the start of next year. Are you concerned about contagion to the rest of the eurozone?
Well, there's contagion, but the issue is real. It's not like it wouldn't be there if Germany wouldn't have these problems if France didn't, or the other way around. The issue is that, Europe has had bad luck. They're one of their major trading partners, China. Domestic demand, consumer demand for luxury goods has really dropped. The tragedy of the war in Ukraine has really damaged their growth prospects. Structural policy has gone nowhere. and they're left with the ECB as the only game in town. And that's kind of what the market is looking at and sort of saying either you're going to compromise on your fiscal goals, with no hope in sight that the budgets will be balanced or be put on a sustainable path, or you're going to have to depreciate the euro through monetary policy. And that's, so depending on which is emphasized, the pressure will either be seen in the rates market or on the euro.
Hey, Steve, good to hear from you. Steve Englander there of Standard Chartered.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.